What's up, you guys? It's Henry. Today, I want to have a discussion about Nobel Prize winning economist Robert Shiller and why he basically cautioned investors on the market and said fear is at its very highest right now. He says low investor confidence and high prices are raising the risk of a market crash and cautions investors not to be overweight stocks. Just to give you guys some insights, if you don't know who Robert Shiller, Bob Shiller himself is, he's a famous economist that teaches at Yale University. I've used his indices all the time during my semesters in college at Drexel when I was studying finance, and he has an index called the Case Shiller, which is a real estate index. He also has a Shiller PE ratio for the S&P 500. That's a price to earnings ratio, which is based on average inflation adjusted earnings from the previous 10 years, known as the cyclically adjusted PE ratio or CAPE ratio, and many more indices because this guy is famous. He literally just pumps out these different indices, and a lot of these indices are really good. Here's Shiller's PE ratio and where it stands currently. It suggests that we are somewhat high right now at 31, and we're actually sitting above 2008 levels. Now, you'll want to watch this video throughout because there is so much more to the story than just the PE ratio itself. And by the way, guys, get your 3 free stocks from Webull when you deposit $100. That promotion is ending this month, and they hook you up with 3 stocks, so it's a fantastic deal. Okay, so Robert Shiller says that the stocks are trading at very high levels, and this does not mean that a crash will for sure happen. It's not going to happen like 100%, but it does mean that uncertainty levels are very high and investors are nervous about the stock market. I mean, we have an election coming in less than 2 weeks. US weekly mutual fund and exchange traded ETFs are outflowing like massively and reaching record highs where investors are basically pulling out cash from these ETFs because they're worried about a potential crash. And have you guys looked at the VIX? It looks like this right now, and it's basically the Wall Street Fear Index. So what Bob Shiller is saying is while investor confidence in the market is low, stock prices are trading at very high levels. But Shiller said that the low confidence readings and high stock prices won't cause a stock market crash on their own. Basically, something else would have to happen though for the market to crash, because stocks don't just crash because they seem to be high. He basically said something has to happen, and that could be similar to maybe other previous crashes or extra fear in the market. And no surprise, extra fear in the market could be due to further COVID cases or a chaotic election, which, let's face it, is just 2 weeks away. This could shake up people the most because elections only happen every 4 years, so that's a big thing, and well, COVID cases really do affect businesses significantly. And this morning I checked on COVID numbers and they were awful. In fact, the US hit its highest 7-day average of COVID cases since the pandemic began. Health experts say that the resurgence of cases that they had warned would strike in the fall and winter is here, and it could be the worst the US has seen so far. I think this is the number one thing that investors should be looking at. I mean, it may even be more important than the election itself because, well, it really does affect businesses. Mainly because a vaccine likely won't protect against the virus up until 2021. So there's a whole lot of uncertainty with the virus itself right now. And I don't think research and scientists are gonna fully understand what they're doing. I mean, they're doing a whole bunch of research, but they're not gonna have a full plan, a full vaccine just yet. I mean, every week it's a different story on which company is closer, but nothing is concrete. So I'm not going to be getting my hopes up just yet for the vaccine. If the cases rise any more this week, I'll probably hold off on investing, period, and any additional amounts that I have to be invested, I'm gonna keep as cash in my portfolio. It just seems to me there's more risk than return in most pockets of the market right now, and I kind of see there was a double peak from like Wednesday and Friday periods in the market. If you look at the chart, it kind of peaked on Friday, and on Monday we're having a huge sell-off, so this kind of makes me antsy myself. Of course, I personally hold a lot of Tesla, so for me, although I'm not concerned as much because EVs are supposed to still do well, I mean, people are gonna still drive their cars regardless of what happens with the election. And speaking of elections, there is a lot of heightened risks. However, I have a chart, and this one is actually going to calm a lot of folks down because you gotta remember, just because there's more volatility, that doesn't mean that stocks only go down. Here's how the stock market has performed before, during, and after presidential elections. I mean, if you see it right here, I'm circling all of the areas where there's a new president, and it's seriously just a similar pattern where it's kind of going up. There is some lessons that we can learn here, and specifically, we can learn something from the 2016 election. The 2016 election serves as a fitting example of how volatility can be present but disappear just as fast as it sets in. This is a lesson on how quickly the market can incorporate new information and recover. If you recall, and I mean, this is about 4 years ago now, so the night isn't so clear, but on the night of the 2016 election, as more states began reporting and a Trump victory became increasingly likely, stock market futures sank rapidly. I mean, the S&P 500 fell more than 5% in pre-market trading, triggering a circuit breaker to halt trading back then. And by the way, the market closed the same day after the election. It was 1% up. I mean, everyone had changed their mind. Everyone was predicting a recession, but that didn't actually play out. Although the stock market is not the economy, it's interesting to conclude that regardless who was president or which party was in the White House, the stock market had tremendous results. I mean, we just looked at this chart right here. It was tremendous over the whole period. I mean, from 1926 to 2020, we've only been an upward trend over the long term. However, in the short term, we've had plenty of volatility, and that's because the stock market is a bet on the American people. It's not a bet on who is president or anything like that. It's a bet how hard and smart American people work and what the economy produces in goods and services, which is otherwise known as GDP. It should be of no surprise that the markets perform better during a year when a president is re-elected compared to a newly elected president. As you guys know, the markets hate uncertainty. A new president can create all kinds of unknowns and uncertainties, the potential for increased regulation, a lot higher taxes in the case of Biden currently, and other shifts the market perceives as anti-business can all influence the sentiment, which influences the stock market. So if Trump wins, our stock market will likely skyrocket higher since uncertainty will be diminished. And well, if he loses, the stock market may have a crash. I think this next week or two will be crucial, and raising some cash in case we see stocks plummet may be a very smart move. Now let me tell you 2 reasons not to worry about the stock market crash during an election, before the election, after the election, and you really need to know these 2 things because it'll help you have a better perspective. 1, you won't lose money if you leave your portfolio alone. The best way to lose money in stocks, well, can you guess it? It's selling them when they are down. The result of the election could cause stocks to react unfavorably, but if you leave your portfolio alone until stocks recover, you won't actually suffer any financial losses. The reason is a market downturn could open the door to buying opportunities. Falling stock values give you a chance to load up on quality investments when they're less expensive. Rather than looking at a potential market crash as a problem, treat it as an opportunity. You see, it's actually a very big opportunity. If you have time to invest, you're going to end up a winner if you invest in stocks that are a little bit cheaper as they fall lower because they are on sale. So you always want to contribute to your portfolio over time and take advantage of opportunities when stocks are falling. That's why having even a small amount of cash available is always a good idea in case an opportunity presents itself. At this point, I would probably say stay low on risk and be invested, but don't be invested every penny. What do you guys think? I think it's gonna be a really big week, so I'll make sure to answer all your comments. And if you need to reach out, I'm always one Instagram DM away at Henry_Moldavsky. It's right here on the screen. I don't think I've ever pronounced my name on this channel before. It is a very long last name. Yes, I am from Soviet Russia and my last name is very long. Anyways, thanks for watching. I'll see you champions in the next video.
Never sees